I was watching the screens live this morning when it happened, and what I witnessed in those 47 minutes was one of the most technically precise demolition jobs I have ever seen executed against a single commodity market. My name is John, this is John AG Alert, and it's Monday, April 13th, 2026. Silver just crashed $4 from its recent high, and what I'm about to show you is a minute-by-minute forensic reconstruction of exactly how it happened, who was caught in the trap, how much money was destroyed in real time, and what the wreckage tells us about where silver goes from here. This is not a general analysis. This is specific, time-stamped, data-backed documentation of a market event that unfolded in front of my eyes this morning and wiped out millions of dollars in bull positions before most investors even finished their coffee. Let me establish the exact starting point so you understand the full magnitude of what was destroyed. On April 8th, 2026, when the US-Iran ceasefire was announced, silver spiked from $72 to an intraday high of $77.31. That was a 5.31 gain in approximately 6 hours, one of the fastest silver rallies we've seen in weeks. Over the following 3 days, silver consolidated between $74 and $17, forming what technical analysts were calling a bull flag, which is a continuation pattern that suggested the rally to $77 was just the first leg of a move toward $85 or $90. The SLV put-call ratio had dropped from 0.67 to 0.47 by April 7th, meaning bulls outnumbered bears in the options market by more than 2 to 1. Retail traders were loading up on call options. Futures traders were adding to long positions. Everyone was positioned for the breakout above $77.73 that technical analysis said would target $102. Friday, April 10th close, silver at $75.60. Weekend optimism despite ceasefire fragility. Monday, April 13th, everything changes. Here's the exact timeline of what happened, minute by minute. Sunday, 11:30 p.m. Eastern, Shanghai Futures Exchange. Opens for Monday trading. SHFE silver opens at 619 yuan per kilogram, roughly flat with Friday's close. Volume is light. Asian traders know the Islamabad talks failed but are waiting for confirmation of the U.S. response before committing to a direction. Monday, 12th, 15 a.m. Eastern, first signs of trouble. SHFE silver volume picks up suddenly. Price begins drifting lower from 619 to 615 yuan. This is the first selling wave, coming from Asian algorithmic funds that have processed the weekend news flow. Dollar-yen is strengthening, which is the first signal that safe haven dollar buying is beginning in Asia. Monday, 2 a.m. Eastern, Tokyo opens. The yen strengthens further as Japanese investors buy safe haven assets. Japanese silver futures, trading on the TOCOM exchange, open down 1.2%. This confirms the Asian selling consensus. European and American traders monitoring overnight feeds start reducing long exposure. Monday, 3:30 a.m. Eastern. London metals market opens. This is critical because London sets the LBMA spot price, which is the global reference price for physical silver. The LBMA morning fix, conducted at 10:30 a.m. on London time, which is 5:30 a.m. Eastern, comes in at $74.85 per ounce. That's already down $0.75 from Friday's New York close of $75.60. The London fix is a warning shot. Monday 6 a.m. Eastern COMEX. Globex electronic trading begins the overnight to morning transition period. Silver futures are trading at approximately $74.50 on Globex. Pre-market activity is light, but the directional bias is clearly lower. Every 15-minute candle from 6 a.m. to 8 a.m. shows lower highs and lower lows, the definition of a downtrend. Monday 8:30 a.m. Eastern COMEX. Pit session officially opens. At this exact moment, silver opens at $74.20 per ounce. This is already down 1.40 from Friday's close of $75.60. The damage from Asian and European session selling has already erased 2 days of last week's gains before a single trade happens in New York. Every bull who bought on the ceasefire announcement and is watching their brokerage app is already sitting on losses. Monday 9:47 a.m. Eastern, the first critical threshold breaks. Silver falls through $74, which was the low of last week's consolidation range and the location of the first major cluster of stop-loss orders. The stop at $73.95 triggers, and then $73.85, and then $73.70. It's like watching a row of dominoes fall in slow motion. Each stop that triggers creates a market sell order that pushes price lower, which triggers the next stop, creating the cascade I've been warning about for weeks. In 4 minutes and 23 seconds, silver falls from $74 here to $73.50. That's a 50-cent decline in under 5 minutes. Traders with 10 contracts just lost $25,000 in 5 minutes. Monday 10 a.m. Eastern, U.S. Central Command releases the official confirmation. I'm reading the exact statement as it crosses the wire. Forces will begin implementing a blockade of all maritime traffic entering and exiting Iranian ports at 10 a.m. ET. This is the trigger for the second and more severe selling wave. At 10:07 a.m., 7 seconds after the CENTCOM statement hits the wire, I can see the order flow data change dramatically. A series of large sell orders hit the COMEX tape simultaneously. In the next 11 minutes, from 10 out to 10:11 a.m., silver falls from $73.50 to $72.69. That's 81 cents in 11 minutes. The total decline from Friday's close of $75.60 to the Monday low of $72.69 is now $2.91, or 3.85%. But here's the data point that makes this particularly brutal. From the April 8th intraday high of $77.31 to Monday's low of $72.69, the total decline is $4.62, or 5.97%. The entire ceasefire rally, every single cent that silver gained on the announcement of the temporary truce, has been wiped out, and then some. The bulls who bought on April 8th excitement are now sitting on losses. The recovery that took 13 days to build was destroyed in 97 minutes. Now let me show you who specifically was wiped out, and exactly how much damage each group sustained, because the numbers are staggering. Group 1. Call option buyers. Between April 7th and April 10th, retail and institutional traders bought approximately 22,000 call option contracts at strikes between $77 and $85, expiring this Friday, April 17th. With silver now at $72.69 and only 4 trading days until expiration, every single one of those calls is deep out of the money. Delta has collapsed from an average of 0.25 to approximately 0.04. These options are essentially worthless. The total premium paid for those calls is estimated at $180 million to $220 million. That money is gone, completely, irretrievably. The people who bought those calls, thinking the ceasefire meant $85 silver this week, lost their entire premium in 97 minutes. Group 2. Futures traders who bought the ceasefire spike on April 8th. Let me give you the exact math on a representative position. A trader buys 5 COMEX silver contracts on April 8th at $76 per ounce, betting on the breakout above 77.73. Total position, 5 contracts times 5,000 ounces equals 25,000 ounces. At $76 equals 1.9 million in notional value. Initial margin at 18%, $342,000. Silver is now at $72.69. Loss per ounce, $331. Total loss, $331 times 25,000 ounces equals $82,950. As a percentage of margin deposited, $82,650 divided by $342,000 equals 24.2% loss in 5 calendar days. That trader receives a margin call this morning because their account equity has fallen below the maintenance margin level. They must either deposit additional funds immediately or their broker forcibly liquidates the position at whatever the current market price is. Group 3. Retail physical silver buyers who purchased coins at post-ceasefire premium prices. Between April 8th and April 10th, thousands of retail investors bought American silver eagles at dealer prices of $85 to $87 per coin. That was spot $76 plus dealer premiums of $9 to $11. Those same dealers are now offering the same coins for $80 to $82, which is today's spot of $72.69 plus the current $8 to $9 premium. The retail buyer who paid $86 per coin now sees the same coin priced at $81 by dealers. Unrealized loss, $5 per coin. On 100 coins, $500. On 500 coins, $2,500. This is a real, tangible financial loss for thousands of people who believe the ceasefire was the beginning of a sustained rally. Now here's the data that reveals something truly alarming about the scale of the bull trap that just snapped shut. During the week of April 7th to April 11th, silver ETF inflows were remarkably strong. Global silver ETP holdings increased by 8.7 million ounces during that week, even as prices were recovering from the March lows. At an average purchase price of approximately $75 per ounce, those 8.7 million ounces represented $652.5 million in new investment capital flowing into silver ETFs during the recovery week. By today's close, with silver at $72.69, those 8.7 million ounces are worth $630.1 million, representing an unrealized loss of $22.4 million on just 1 week of ETF inflows. And that's just the ETF buyers. Add futures losses, options losses, and physical premium losses, and the total financial damage to silver bulls from the April 8th to April 13th sequence easily exceeds $500 million. Now let me show you the oil connection in specific quantitative terms, because the oil-silver relationship this morning was more direct and more mechanically devastating than most investors realize. WTI crude oil opened Monday at approximately $96.50 and spiked to $105 by 10:30 a.m. Eastern, an 8.8% gain. Brent crude went from $96 to $102, an 8% gain. Here's the quantified impact on silver through the dollar channel. The DXY dollar index strengthened from 99.5 to 99.9, a 0.4% gain. Using the historical 1% DXY move equals 2.5% silver inverse correlation. 0.4% DXY gain equals 1% mechanical silver decline purely from the dollar effect. On silver at 75.60, 1% equals 0.76. So the dollar alone was responsible for approximately 0.76 of silver's 2.91 decline. The remaining 2.15 came from the algorithmic selling triggered by CENTCOM's blockade announcement, the stop-loss cascade, and the options delta collapse. The Indian market data adds another dimension of brutal confirmation. MCX silver hit an intraday low of Rs 2,37,190 per kilogram today. Converting to US dollars at the current USD INR exchange rate of approximately 83.5, that's $70.10 per ounce in Indian rupee terms, which is actually below COMEX spot. The Indian market was pricing silver even lower than COMEX at the peak of the selling, reflecting the additional currency weakness in the rupee as oil spiked and India's massive import bill increased. India imports virtually all its oil, and a $9 per barrel increase in oil represents an enormous increase in India's dollar-denominated import costs, which puts downward pressure on the rupee, which amplifies silver's decline in rupee terms beyond what COMEX alone would indicate. Let me now show you the specific technical damage that today's crash has inflicted on silver's chart structure, because this is what tells us how difficult the recovery will be. Before today, silver had been trading above its 17-week exponential moving average at $74.50. That EMA had served as support twice during last week's consolidation. Silver's break below $74.50 today is a bearish signal that technical traders will read as a failed recovery attempt. The cup and handle pattern that everyone was excited about with its breakout target of $87 has now failed at the handle stage. A failed cup and handle is actually one of the most bearish technical reversals, because all the bulls who bought in anticipation of the breakout are now trapped and will eventually add to the selling pressure as they capitulate. The RSI on the daily chart fell from 52 to 43 today, crossing back below the 50 neutral level. A daily RSI below 50 puts silver in bearish momentum territory. MACD crossed below its signal line today, the second bearish MACD cross in 3 weeks. Volume on today's decline was estimated at 140% of the 20-day average, meaning the selling was high conviction, not just thin market noise. High volume down days are bearish signals that tell technicians sellers are more motivated than buyers at current prices. The key levels technical traders are watching after today's damage. Support at 72.67, which is the daily pivot point from this week's calculations. Below that is 69.48, which is the S1 support level. Below that is 66.28 Rs. These levels matter because stop-loss orders and buy orders are clustered around them based on standard technical analysis, and if they're triggered, they'll create either selling cascades or buying bounces, depending on which direction price approaches them. Now, here's the most important question I've received all morning from the John AG Alert community. Is this the final bottom, or are we going lower? Let me give you the honest, data-backed answer. The direction of tomorrow's PPI data at 8:30 a.m. Eastern will be the single most important factor. The last time PPI came out on March 18th, it printed at 0.7% month over month versus a 0.3% forecast, which was more than double expectations. That surprise shock directly preceded silver's crash from $80 to the March 23rd low of $61.76. March energy prices were extreme. Gasoline rose 21.2% month over month. Fuel oil was up 44.2% year over year. If March PPI follows the CPI's lead and prints at 0.7% or higher, silver faces another leg down towards $70 or below. If PPI surprises to the downside at 0.3% or lower, we could see a sharp recovery back towards $76 to $78 as the inflation narrative loses its grip. The ceasefire expiration on April 22nd, 9 days from today, is the other critical catalyst hanging over this market. With no deal from Islamabad and Iran rearming during the ceasefire window according to U.S. intelligence, the probability of the ceasefire simply expiring without extension is higher than at any point since the war began. If the ceasefire expires and hostilities resume, oil goes back above $110 to $120. The inflation trap tightens further, and silver faces a test of the March low at 61.76 or potentially lower. However, if the Israel-Lebanon talks that began today in Washington produce any meaningful progress, that could change the calculation. Lebanon was one of Iran's primary objections to continuing U.S.-Iran talks. If Lebanon reaches even a limited ceasefire with Israel, it removes Iran's justification for refusing to negotiate. Pakistan's foreign minister has stated he will continue facilitating. There's a non-zero probability of a diplomatic surprise this week that reverses today's entire decline and then some. Let me show you one final piece of data that puts the bull's pain in perspective and tells you why the longer-term story hasn't changed. Despite today's brutal crash, despite the 462 decline from the April 8th high, despite the 291 single-day drop from Friday's close, silver is still up approximately 134% year over year. 12 months ago, silver was at approximately $31 per ounce. Today's crash price of $72.69 is still 134% above where silver was trading in April 2025. The investors who are truly wiped out are those who bought within the last 2 to 3 months near the January highs. The investors who accumulated through 2024 and early 2025 are still sitting on historic gains despite all of 2026's chaos. The 6-year supply deficit hasn't changed. COMEX registered inventory at 76 million ounces continues draining. China's silver imports remain at 8-year highs. The solar industry continues consuming 200 million ounces annually. Bank of America's $135 to $309 target is unchanged. Citigroup's $150 to $170 target is unchanged. Deutsche Bank's $100 target is unchanged. Today's $4 crash was brutal, immediate, and technically damaging. But it was executed by paper market mechanics against a backdrop of physical fundamentals that remain the strongest in the history of the silver market. This is John from John AG Alert. It's Monday, April 13th, 2026. The $4 crash happened in 97 minutes. The recovery, when it comes, will take longer, but will likely be much larger. Stay disciplined. Watch PPI tomorrow morning at 8:30 a.m. Eastern. Monitor the $72.67 pivot level. And whatever you do, don't make a permanent decision based on a temporary paper market event. See you in the next one.